So I think for me, ESG is these two lenses. It's protecting you as an investor from things that might blow up, but it's also having their environmental and social impact.
I looked at it from the standpoint of diversity in terms of ESG, not because we set out to do so. I just think we naturally are there.
That's Michael Lewis, Head of Sustainable Finance Research at DWS, Ed Butowsky, Managing Partner of Chapwood Investments. Plus, we'll hear from Brian Maute, Divisional Director of DWS. We'd like to thank DWS for sponsoring the live ETF Think Tank Exchange, as well as this podcast.
They're changing perceptions in the ESG space to bring more clients into your practice. I'm Dave Armstrong.
And I'm David Dziekanski. Welcome to the ETF Think Tank podcast.
Hey, David. It's great being a co-host with you on this podcast.
It's going to be a good one. A note to our listeners. Join us for the live ETF Think Tank Exchange shows where you can earn CE credits while learning from our experts.
And as always, our goal in both the live show and in this podcast is to provide thought leadership, which can bridge the gap between investment producers and the advisors who are using their products through actionable ideas.
In this episode, our very own Dan Weiskopf and Michael Guyette, alongside Michael Lewis, Ed Butowsky, and Brian Maute, we'll discuss ideas to change investors' perception in the ESG space. Ideally, to bring more clients into your offices to explore more opportunities that fit with their values.
And then David and I will return with some ideas that we think can make a difference. But for now, let's get on with the show.
Let's maybe kind of just start the conversation off by setting the stage in terms of what exactly ESG stands for and what it is.
I think it means two things. It first of all means risk management. And just as you go to a doctor and you go to the hospital to get an X-ray to figure out what's wrong with you, that's exactly what risk management in ESG is all about. It's doing an X-ray on your portfolio, which you didn't think risks were there or possible opportunities, but you're really trying to disentangle what was historically information that you didn't actually think was very material. So we've now started to see the materiality of things like climate change, floods, wildfires, or it could be how does a company treat its employees and its staff and its workers and its supply chains and contractors and customers. So that's the risk management side of it. The other angle of it is impact, which for me is a much more inspiring part. And not surprisingly, if we're looking around the world at the biggest impact investors, the majority of them are in the United States. And this is what you call inside out. How does my investments impact the world? And do we then and we want to actually try and measure that impact. It's not just about financial return. You're also looking at the environmental impact and the social impact. So typically a lot of that impact investing activity was very much in private markets. It was sort of private equity, debt, things like microfinance, or it could be sort of clean tech or sort of agricultural solutions in Africa. I mean, really quite distinct and frontier investments. But actually, if you look at the United States, the US municipal bond market is sort of like an impact market because that is the investments in water infrastructure, schools, social housing, things like that. Those have quite positive environmental or social benefits. So I think for me, ESG is these two lenses. It's protecting you as an investor from things that might blow up, but it's also trying to have impact on the rest of on what are your investments having in terms of their environmental and social impact.
You know, Ed, earlier we were talking a bit about how ESG impacts our businesses. How are you looking at your business through the lens of an ESG profile?
Yeah. I looked at it from the standpoint of diversity of employment and who we're hiring, and we're doing very well in that respect. We're doing very well in terms of our carbon footprint, although I leave the lights on when I leave the office. But every little bit helps. But also as an RIA, marketing ourselves as an ESG firm where we're very compliant is also a wonderful way for RIAs to position themselves, not just from an investment standpoint, but from how they handle their business. Because a lot of younger people, I don't want to say older people aren't involved with ESG, but a lot of younger people are very into, are you ESG approved? And as, wealth starts to transfer from older generations to younger generations, it's nice to be able to position yourself and market yourself as an ESG compliant firm. So, I think it's a wonderful thing to have. And I believe that we're doing a very good job in terms of ESG, not because we set out to do so. I just think we naturally are there.
So let's hit on this compliance issue, Mike, because I think this is where there's a lot of confusion in the space. And it seems like there's no sort of standardized way of doing it, although it sounds that DWS effectively is known for that. Talk us through sort of how do you define what's ESG compliant? What kind of rules have you put in place? Why are those rules there? Take us through the process from an institutional level.
Yeah, so data is very, very helpful in trying to establish what's in and what's out. So compliance can be a number of things. We would tend to look at sort of multiple different data providers to provide us information on companies. I may be doing some case studies is sort of interesting because it's not easy. I think when we look at net zero and, companies, governments, investors, they're all signing up to a pledge in the future to have basically a zero carbon footprint. Now, naturally, coal is a really is almost a public enemy number one when it comes to net zero. So people are looking at the compliance of their portfolios relative to coal, for example. And so naturally, you'll start to say, right, but the problem with the coal company is that they're typically not just a coal company, they're a diversified miner. So how do we actually disentangle all of that? So what you tend to do is you tend to have certain thresholds. You may well say, let's say, is it 20%, 30%, or 50% of the revenues of a company that's derived from coal? We need to take that out of the portfolio. And we're not just taking it out because it's dirty, but we're doing it for financial reasons because we're saying that the risk of holding coal assets is much more dangerous today than it was 5 years ago because those coal assets could well be valued at zero by the time we get to 2030 or 2040. But then you say to yourself, okay, well, what about the shipping company that's transporting the coal from Australia to China? Do we exclude that company? Do we exclude the accounting company that's auditing? Because so you can tie yourself in knots. And so I think what the market is trying to do is try to establish these types of thresholds, these ways of reducing portfolio risk, particularly as it relates to carbon. And a lot of that has been done by using ratings. Now, this is one of the real hazards and pitfalls of ESG investing, is that there are multiple data providers out there providing you with ratings of coal companies to technology companies, and each of them have got different weightings. Each of them are probably using slightly different data sets. So these are sort of some of the headaches that we have, because you can have the brilliant electric vehicle company based in the US that's great on environmental, but people are worried about the governance of that company. And so this is where these ratings can get really messed up. So it's not easy. It's complicated. You need a lot of good data. And we want to see more companies providing us with better information of what they're up to. So compliance runs in different ways. But I would say when we look at an investment proposition or in a company, we typically start off by looking at the governance of that company. Do they have the ESG metrics and frameworks in there that give us a bit of confidence that they're going in the right direction?
This question's a little bit for both Ed and Michael, but Ed, you should go first. When I think about ESG, I also think about who the buyer might be. Should you be looking at your practice a little different on how to position, the ESG and who your clients are, especially given that some of them are athletes?
Yeah, I would say that without question that I should be promoting more of ESG and teaching the family offices why it's so important. And I think a lot of people just aren't aware. I think they just hear ESG and they think of global warming, and they don't think about, the board of directors and the anti-corruption and the anti-fraud and so on, everything else that goes along with ESG, because ESG itself is not just on the environment. Because some people have different feelings about climate change, and they don't really want to see climate change impact their investments. But sadly, it is, and they need to be aware of that. So, from the standpoint of my athletes that I manage, I think that a lot of them need to become more aware. I think they hear about this, but they have a hard time, understanding investing alone. then to factor in the ESG component to it. But this has really been a big change for me in getting prepared for this, and I'm very much in tune to trying to market more of ESG and position my firm that way, and then position investments that way. Because, as you know, there's ESG investing is a lot stickier. People who invest in ESG companies are less likely to sell them. And you also, for a number of reasons, there's increased stock liquidity because there's more and more people buying into it. And the other thing is you keep activists at bay. If you're ESG compliant, you'll have less reason to worry about activists coming to and trying to get into a company and take it over.
Yeah, and I think what's also important is to actually explain that, because I think there's been a misperception of ESG that it's a cost and it conflicts with your fiduciary duty. It's a burden. And I think what's been interesting over the last 50 years is how there's been an enormous explosion in the research in this area. I mean, that's kind of, I sit in this space and it's a very hot research space. And we did a study in 2015. We basically found 2,000 unique studies looking at the link between ESG and financial performance for companies. That 2,000 has kind of doubled again in the last 5 years. It took 50 years to get us to 2,000. We've now gone an extra 2,000 in 5 years or so. And I think what's been interesting is we're also seeing a real change in investor perception. You ask institutional investors and retail investors, is ESG a cost or is it a benefit? And, it used to be 3 or 4 years ago, everybody just said it was a cost. Now it's really changed. And I think when you explain to people, particularly in certain asset classes like real estate, we moved to a really nice building in London, better air quality, better lighting, more efficient wastewater management. It was a win for everybody. The tenants, we were in there going, this is great working environment. The studies tell you that productivity goes up when you go into better buildings, better lighting. The landlord is obviously pleased because he's got lower energy bills and better wastewater treatments and things like that. And then the investors benefiting as well. So, you can really look at certain asset classes where this thing really works well from an investment perspective, and intuitively it makes sense. And I think people like to understand why it's working. And I think you can give some really good case studies from asset classes as to why it works. You look at infrastructure, you've had Hurricane Sandy hitting lower Manhattan, you've had wildfires, you've had, infrastructure around the US. I mean, I think climate related, if you're a bit skeptical on climate change, just look at the numbers. $1.8 trillion of losses in the United States since 1980 relates to extreme weather events. 1.8 trillion. In Europe, it's about 480 billion. Now, you might say, well, the US is a big economy, richer assets, but fair enough. But still, that is material financial risk. And so you've got to build that infrastructure, because if you don't build seawalls in California and Florida, I remember seeing a picture of a house. I can't remember, it was in one of the hurricane corridors in southern United States. And this chap had built this absolutely incredibly resilient house that would beat any hurricane, which he was right. But the problem was everything around him was flattened. And so you can be very resilient as a company or as an individual, but you need everybody around you to be resilient as well, because you could just be the last building standing, in downtown, South Florida or somewhere, but you won't have all the services to get to you. So I think that ESG is another thing. It's got everybody has to get involved. It's not just governments and local governments, but it's investors, it's banks. It's the whole caboodle, or whatever they say. And so this is another complexity, but it kind of does require a lot of this engagement and connectivity. And that's why you see so many coalitions kind of being set up, whether it's investor coalitions or governments kind of coming up with global agreements. So that, I think, is another part of why it's quite a difficult space, is you've got so many of these moving parts.
So let's talk about something which is near and dear to my heart, which is risk off periods. So I saw a study that you referenced that shows that companies that rank well on the ESG side tend to actually do better than other companies when you have these major drawdowns in equities, corrections, bear markets. And I know, Ed, that like me, you've been expressing concern about sort of the broader equity space. And I want to hear your thoughts, Mike, on sort of how should advisors think about downside protection? Yes, it's still equities. Yes, it's still beta. But how does ESG maybe impact the volatility dynamics when everything breaks down substantially in broader equity markets?
Yeah, well, I think what's really interesting, if you look at, well, there are several examples, but I mean, I think COVID, and we've had actual experience of how this has impacted investment returns. And we can look at ESG indices, ETFs, versus their parent indexes, and to get a sense of, what's been the difference, who's been more resilient, which one has been performing better. And I think what's been interesting, there's been a lot of sort of examination as to why have ESG indices done so well over this period. There was definitely signs of an ESG quality effect, whereby the higher quality names on an ESG basis were outperforming. And I think, Ed's point of sticky investors, ESG is all about long-term investing. I do think that also sort of plays a bit of a role in terms of the turnover that you will see in those sorts of companies. And I think that's where, the market is moving.
So my question to Ed, would you consider ESG bonds if you're going to de-risk your portfolio?
Yeah, well, without question. I mean, something to go back to what Michael was saying about the employment, you tend to attract better talent on an ESG company because there are people coming out of college, have been, taught about ESG, a lot of the younger people. And, so people up until their 30s and 35 years of age, which are at their critical time period to really add value to companies, and into their 40s, are really ESG proficient. And these ESG companies tend to, attract the better talent and retain that better talent. In terms of the bonds, without question, because there's going to be less volatility on those companies, because people are going to be stickier and going to hold on to them longer. So I would absolutely look towards those. And if you look at what an ESG company is, I mean, you're looking at Google and Microsoft and Visa. You're not looking at, these, off the beaten path companies. You have, according to DWS's strategy, and if you look at their holdings, they're very solid companies. Marriott is one. And so you're not really going out on the risk curve by buying an ESG company and buying their debt at all.
All right. So Ed, you're in Texas. Obviously, Texas is rightly or wrongly known for a lot of oil and energy. And arguably, I think the energy space is not as ESG compliant, at least across the board on average. How do you try to communicate to clients ESG is still a better play? Talk us through sort of the communication process on your end.
Yeah, I mean, that's a tough one. And, oil prices have skyrocketed, and they're probably going to $90 a barrel. And the last thing I want to do is sell people out. And I'm an investor in them. And the last thing I want to do is sell people out and tell them that there's potential financial costs 5 to 10 years down the road. They'll have another advisor 5 or 10 years from now if I do that. So it might be looking at each individual company to see which one is turning more towards alternatives. ExxonMobil, I know, has a heavy push towards alternatives, and maybe it's a matter of focusing attention on that.
And you're absolutely right. It's the time horizons, isn't it? I mean, that's how we need to sort of be looking at this, because there's obviously cyclical opportunities that we want to grab, but there are also slightly longer term risks that we kind of need to face, and opportunities as well. Because I think maybe ESG, we spend a bit too much time talking about all the risks, but actually this is quite a growth story as well. If you're looking at the renewable sector in the US, I mean, I think it employs, 3-4 times as many people than say the coal sector or the oil and gas sector. So I think these sort of stories, I think, also need to kind of come out, that it is quite green jobs are quite a fast growing part of the economy. They typically are quite gender diverse as well.
Okay, so Brian is like the tall, dark, and handsome guy that shows up late in the cafe, but everybody wants to hear from him. So Brian Mott just joined. So Brian, I'm going to prompt you to come in as a part of TWS as well. We talk kind of big picture, but I want to kind of get a little bit to the nitty gritty as far as how DWS in its products actually implements some of these concepts. Talk us through sort of the ETFs and how you think advisors should think about it from an execution standpoint.
Yeah, thanks, Michael. And I'm usually not referred to as tall, dark, and handsome, so double thank you on that. But to Michael's point, when you think about ESG, it really comes down to what does it mean for the actual investor. And so what Michael was talking about is some of the things that we do kind of behind the scenes at DWS with our ESG engine, and that allows us to not only go through a screening process of securities, but it also allows us to kind of come through and, as Michael was alluding to, for a client, whether it's an institution, whether it's somebody who's trying to create an ESG-only portfolio, or within our packaged ETF solutions, it lets us give you your key performance indicators. So you look at the line item of E, environmental. What are you doing within this portfolio to actually help relative to your benchmark improve environmental standards? What are you doing with social standards to actually help improve, as well as governance? So we can measure things such as the amount of carbon that you're reducing, carbon footprint that you're reducing. And so when we work with our partners for our ETF solutions, on a quarterly basis, we'll print these KPIs, share them with advisors that can share them with the clients so that they know if you're going to use a solution with DWS relative to if you're just using a plain index, what are the tangible benefits that you're helping to achieve from an ESG standard? And we find that that's a really compelling way that advisors are starting to introduce this concept now to their clients, help let them know, look, it's a good portfolio, it's a good investment solution because you can look at the risk and return characteristics, but also for what your personal objectives are, it's helping you achieve certain things within the ESG.
Well, let's kick off with some ideas that might make a difference. I think what we've seen here is really the importance of how these things are constructed together, and not only today, but how they're going to evolve over time. One of the most interesting topics we think in the ESG space that was discussed here on this podcast is what to do really with the oil companies, right? Right now, it makes some sense to exclude them from the indexes or lower their allocations, but whether by choice or activism, one or two, if not a few of these companies down the road will truly be ESG companies. And that evolution of the philosophy of the approach to your ESG portfolio is more important now than ever.
David, you've hit the nail on the head. And this was, to me, the biggest observation and frankly, the biggest surprise out of today's discussion with Michael Lewis. I think so many investors and advisors have been looking at the ESG space and it's been a little bit amorphous. This is the first company that we've spoken to that, number one, has developed a framework with which to think about, number one, where the risks lie in ESG, for example, with oil companies as they exist today. And then on the opposite side, where impact is really being made. And as I think both you and I, as statisticians and investors, would appreciate, one of the, I think, most important elements to have is, number one, a framework that, number two, is measurable. And DWS has the ability to come out and screen out those companies that they think don't fit the ESG because of risks that they present. Oil companies, to your point today, but then also those companies that are having a positive impact, and then can, in reflection, come back and see whether or not that prediction is correct and adjust over time. I think it's just an amazing model.
Yeah, and they spoke in depth about really the desire to seek for more and more knowledge, more and more KPIs and points from these companies to further ensure and further screen all of these companies within their ESG implementation, which I think, again, is just completely super necessary in this world, as there's tons of very, very bland ESG screens that companies can kind of get by. And that's why you've often seen like large cap bias in the ESG names, because they can spend the money to try to pass these kind of nominal benchmarks that don't really get the job done. And the ever desire for more and more data here and more KPIs from these companies and independent parties, I think, is really key here in differentiating the strategy.
David, you've done most of the work that we share here at Taroso around ESG investing. Do you find that there's a lot of heterogeneity, or, just to state that a little bit more simply, a lot of variation in the degree to which various ESG offerings either are or are not true to that idea?
Absolutely. It could vary based on your diet or your preference for governance or environmental. And I think the hardest thing is that the opinions of the individual investors are actually evolving over time. Like everyone's perspective and thought perspective on what ESG is ever changing, which again, I think highlighting the focus on more and more information is what I find so exciting here more than anything.
And we get to do the same thing here. As some of our listeners know, at the ETF think tank, we tend to focus in on data. I love that DWS has an ability to create a framework and then apply that in terms of what they do. We on our end get to be able to see whether or not that's indeed the case. So using some of our think tank tools, you can see that comparing, for example, some of their ESG X trackers to a traditional index, you can see where they're overweight more ESG friendly spaces and underweight some of the spaces that investors would want to exclude. So being able to make that tangible and then provide it within a portfolio gives some tremendous tools to advisors who are looking to try to apply some of the same thinking on asset allocation in a really constructive way. So today's discussion, I think, was just superb.
And what's different now from 4 years ago is not only do they have the concepts of what they're trying to provide, they actually have the track record of return showing that you can not lose out on long-term returns and potentially even have the opportunity to outperform while still having a more positive impact.
Kind of makes you excited to see what happens over the next couple of years, doesn't it?
Absolutely.
This is going to be one to watch, I think, for sure. Here at the ETF Think Tank, we're not just about making money, we're also about giving back. And in that spirit, Ed offers up an idea for a charity that may be of interest to you, supporting a local entity. Let's hear what he has to say.
Talk us through your chosen charity here.
Yeah, mine is Minnie's Food Pantry. This is a food pantry in North Dallas, and it's run by a friend of mine. Her name is Cheryl Action Jackson. Some of you might have seen her interviewed by Oprah. And she took a food pantry that her mother had started and grew it exponentially. And she's the most giving, caring person out there. And there's a lot of people in tremendous need. And she is always out there raising money, not making any money herself. She could make a lot of money doing anything she wanted in her life, but she decided that she wanted to give back. And the food pantry is known all over Texas and literally all over the country. But it's just one location in North Texas. And in the North Dallas area. And I support it every chance I get. I go to their fundraisers. And so any chance anybody gets to support it, I would encourage you to.
Minnie's Food Pantry in Dallas is a great example of how you can support your local community. We encourage you to look for opportunities where you live. It's very rewarding to give.
So today, as we wrap up, we'd like to thank Michael Lewis and Ed Butowsky for their thoughts and their insights. And again, we also thank DWS for sponsoring both the live ETF Think Tank Exchange as well as this podcast.
You can learn more about the ETF Think Tank and Think Tank Exchange by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
That's because our value prop is to enhance yours. So until next time, let's keep the exchange going between you and your clients and the advisors you know. I'm Dave Armstrong.
And I'm David Dziekanski. Take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness. Nor does the sponsor organizer recommend that the information shared during this event serve as the basis of any investment decision. And it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.